Guys, investing has been a big part of my life since around the dot-com bubble back in 2001. And over that time period, I have learned a few lessons that I think are very important. And if you'd let me, I would love to share them with you. You're watching More Money? Let's get it. Hey guys, really early into my investing journey, I actually read a textbook in university that mentioned a guy by the name of Peter Lynch. Now, I was already super interested in investing as we had just come off the dot-com bubble. So I ran down to the bookstore and picked up a copy of Beating the Street by Peter Lynch. What I didn't realize was that one simple choice to hop over to the bookstore completely changed my life and sent me down this road of discovering Warren Buffett, Benjamin Graham, Seth Klarman, and real value investing principles. More specifically, the importance of learning what really makes up a great long-lasting business enterprise, and what it takes to be emotionally stable with ice running through your veins as you're sending in that buy order while the sky around you is falling. I can only imagine what would have happened if they didn't have that book at the bookstore that day, and I might have just forgotten about it and just went on with life. This channel may not have ever existed. And I'm sure you all have similar stories of what brought you into the world of value investing. If you're comfortable with it, I would love for you to share exactly what it is that brought you into the world. Let me know in the comments below. I respond to absolutely everyone. With that being said, over time, I've learned a few lessons that I would love to share with you here in this video. So please smash that like button and let's get into it. Now, if you watch Everything Money, which is a great channel, they mentioned that they have 8 questions that they check when analyzing stocks. And they even have a criteria tool that sort of gives you a green light on each of them. But if you listen carefully to them, they do mention that those 8 or so questions are a jumping off point to doing more research, which is something I absolutely agree with, and it leads me to my very first lesson learned, which is the following. Every company and situation is unique, and so your questions should be broad and all-encompassing enough to ensure that you don't miss anything important. So the first lesson that I would love to impart is that I address that by asking the 4 questions as outlined by Warren Buffett. If you're not familiar with these questions, I will link a video in the description where I go through them in detail. The overall idea here with these questions is that it really forces you to understand the business from a quantitative and qualitative perspective. You do your best to understand the management, their approach to capital allocation and preservation, their closest competitors, and all other economics as it relates to the business. In other words, buying a stock should be exactly like buying a private company, and you should be doing as much research and due diligence that you would do in that situation. The only way to really do that right is by telling yourself that after you buy the stock, the market will close for 10 years and you'll have to live with the investment. The only thing that you can do after you buy the stock is read the financials and other management materials to keep up to date with the health of the business. I largely do that today, which is why I haven't been rattled one bit with the near 50% decline in the Alibaba share price since I bought it. I don't care where the share price is because value is what I paid for when I decided to buy the company's shares. I understand that the company is facing regulatory challenges and operational challenges with greater competition, but it's ultimately worth more than $100 per share or so, which is near to where it's trading at today. The second question is a tough one, but it is that you will absolutely be wrong. This is a hard one because your ego will always get in the way, but you have to accept that no matter how much thought, effort, and care you put into your analysis, there will be situations where you're just going to be wrong. For example, we could be wrong on Alibaba and it might actually be worth less than $100 per share. I currently don't believe that, but we'll see what the future holds. So in order to address the fact that you could potentially be wrong, you have to change the way that you frame your expectations, which means that you should go into your portfolio strategy with the expectation to do your absolute best, but also with the understanding that you will make mistakes and that it is okay to make those mistakes. So forgive yourself when mistakes happen. You are not an infallible supercomputer. You are human. Do your best to admit to yourself in all honesty when you do make mistakes, learn from them as much as you can, and then move on. Don't dwell on it. And the third lesson is more of a tactical one, but I'm surprised with just how many people are unaware of this. It is, how do you actually make money with stocks? Now, as popular as the saying is, you don't really make money by buying low and selling high. There's a deeper relationship at play here. A company's value is ultimately the present value of all the future cash flows of that business, which are expected to flow to the shareholders. So in other words, the earnings of the business. The earnings per share divided by the price that you pay for those shares is your earnings yield. The earnings yield is actually the first way that you make money in stocks. Obviously, the higher the earnings yield, the higher your annual earnings will be. A company can either pay those earnings out as dividends, which most people are well aware of. They can also perform share buybacks, which effectively reduces the share base, which increases your future earnings per share and thus should increase the share price. This should give you a capital gain theoretically in proportion to the dollar amount of the shares repurchased divided by the market cap of that company. If the dollar amount used to repurchase the shares is the total income that the company generated in that year, the capital gain should match the earnings yield. There are two further considerations that you have to be aware of here. The first one is that if the company keeps that excess cash from its earnings and puts it on the balance sheet, the market value of the company should increase because the value of the company is theoretically the present value of future cash flows plus its excess capital. The second is if the company reinvests that capital into the business, it could potentially raise future earnings, which takes us into the second way that you can make money with stocks: valuation expansion. A company can do a few things to increase its value, but the most important one is increasing its future earnings prospects. This means that investors will expect the company to earn more money in the future and thus pay more of those earnings out today. That's exactly how you get those high price to earnings multiples. And as you imagined, if the company's future earnings prospects diminish, the valuation can come down as investors expect less future earnings. This largely covered the basics, and there are many nuances and complexities here, but I'll leave it at that for the sake of the length of the video. Tell me what brought you into value investing. Also, if you don't mind, tell me what your number one lesson learned was, because I think that there's a lot of viewers that are reading the comments that could benefit from your insights. Also guys, Cardinal Health is one company that I absolutely love as they're buying back more and more shares and raising that dividend with their free cash flow. I did a quick series on them, which you can get to right here.